Thank you. Good morning, all, and welcome to Redefine International's full year results presentation for 2015. The senior management team of myself, Stephen Oakenfull, Deputy CEO, Donald Grant, CFO, and Adrian Horsburgh, the Property Director, will be presenting today. There'll be time at the end of the presentation for questions and hopefully answers. If we move on to the highlights, it's been an active and successful year on many fronts for the group, with a number of significant highlights. The primary focus has been on the completion of our repositioning to the core markets of the UK and Germany. This has been done through the successful recycling of over £145 million of capital through the disposal of non-core assets, including the Swiss portfolio and Cromwell Group in Australia. The disposal of the latter, realising net proceeds of just over £57 million. At a property level, we have seen strong tenant demand, resulting in occupancy increasing to 98.1%. I'll leave Adrian to cover further aspects of our portfolio, but it's pleasing to highlight the fundamental strength of our assets in the current market, as seen by the occupancy level. This brings me on to the undoubted highlight of the year, albeit that it only completed or partly completed post-year end, and that's the acquisition of the Aegon UK portfolio, which we'll refer to as AUK in the remainder of the presentation. This is a major coup for a group like us, and we believe it will transform our overall portfolio into a higher quality, more sustainable one with greater defensive qualities. On to the financial highlights, but before I go into the detail, I'd just like to say that the acquisition of a portfolio such as AUK in today's extremely competitive markets is not a straightforward business. Delays in completing the transaction has inevitably led to us holding more cash than we would have liked for a longer period of time, and this has had the impact of a cash drag on our earnings per share line. And we estimate this at between 0.11 pence and 0.15 pence, but Donald will take you through that in more detail. Notwithstanding this, we've produced record distributable earnings of £44.4 million, an increase of 13.6% over the 2014 financial year. The full dividend of 3.25p is 1.6% up on 2014 and in line with our target dividend growth rate of CPI plus 1 to 2% per annum. The adjusted NAV of 41.7p is up 3%, despite a negative movement in the Australian dollar of circa 25% and the euro of circa 8% over the financial year. The balance sheet was, however, significantly stronger at year-end, with both the amount of debt and the cost thereof substantially reduced. The cash balance of 96 million year-end has been largely utilised to fund the first tranche of AUK deal, and Donald and Stephen will take you through further details on that metric. It's now time to hand over to Donald, our newly appointed CFO. Donald has been with us for just under 3 months, and we've been massively impressed with how he's picked up the baton in such a short space of time. I'll hand over to Donald.
Thank you, Mike. Just to give you all a bit of background on myself, I joined Redefine International in August, just in time for the execution phase of the AUK acquisition. As Mike said, the acquisition completed post the period end, so the results I'm about to take you through obviously don't include that. You'll see the impact of this acquisition when we meet again at the interim. You may be pleased to know I'm a chartered accountant. I'm from New Zealand. I trained at Coopers & Lybrand. And for the last 20 years, or just under 20 years, I've been in the UK working in the property and financial services sector. Looking forward to getting to know you all over the coming weeks and months, but without further ado, I'll take you through the results. Turning first to earnings. This slide shows the composition of our earnings available for distribution. Net rent has increased 1.9 million following the full year impact the acquisition of Western Fayval, and the purchase of certain joint venture interests in the previous year. Investment and other income, which includes 7.5 million received from Cromwell, has remained broadly flat. Administration costs have fallen, but this is more so due to the costs incurred in the prior year related to the group's REIT conversion and internalisation of management. Net finance costs have fallen 1 million due to both disposals and a weakening of the euro and Aussie dollar. Other items include the add-back of exceptional finance costs, such as termination charges, and unrealised fair value gains and losses. Further details are included within the appendix. Distributable earnings of 44.4 million represents a 13.6% increase on 2014, a 2% reduction on a per share basis given the additional shares on issue following the March placement. The board has declared a second half dividend of 1.65 pence per share, taking the total dividend paid and payable in respect of 2015 to 3.25 pence. Marginally uncovered due to the cash drag mentioned earlier, arising from the delayed deployment of funds from the capital raise. However, following the acquisition of AUK, these funds have now been successfully deployed. This chart shows the change in adjusted NAV since August 14. An adjusted measure is shown alongside EPRA NAV to reflect the negative equity position of the Delta and Hague assets. Note that the Delta position has now been released, so the adjustment at August 15 represents just that of the Hague, approximately 10 million or 0.7 pence per share. Distributable earnings of 3.2 pence were offset by dividends paid, the 3% increase in NAV attributable to the accretive impact of this year's placement, and property revaluation gains, offset by the net loss taken on Cromwell, mainly the result of underlying currency weakness. Turning now to the valuations. Despite the euro moving against us, was down a touch over 8.5% year on year, the overall portfolio has grown by 2.2% like for like. Stripping out Europe, the UK valuation growth was 5.6% like for like, driven by a small compression in yield and an improving occupational market with lower voids and tenant incentives. Principal acquisitions were the Doubletree Hotel in Edinburgh, acquired last September, and a portfolio of German retail properties acquired in January in joint venture with our major South African shareholder, Redefine Properties. Disposals include the sale of historic Delta assets in the early part of this financial year, and at the other end of the year, in late August, we completed on the disposal of the Co-op portfolio in Switzerland. This chart illustrates the key movement in cash across the year. The effect of the cash drag on earnings is clearly seen with our average cash balance much higher than we would ordinarily like. The majority of opening cash was invested in acquisitions, being the Doubletree Hotel and our new German joint venture mentioned earlier. Operating cash flows of 44 million were offset by dividends paid of 21 million, the difference being the result of the scrip alternative now offered. Cash generated from disposals primarily went towards paying down debt. We ended the year with a cash balance of 96 million, which when adjusted for sale proceeds mentioned earlier, both received in early September, our cash balance increased to 165 million. Key debt and gearing metrics are shown here. All measures are pro forma adjusted for the disposal of Cromwell and the Swiss assets, reflecting the repayment of debt, the cancellation of swaps, and the receipt of cash. LTV has continued to fall from 56% a year ago to 41% immediately prior to the acquisition of the AUK portfolio, the first tranche of which is now complete. Weighted average debt maturity has moved out slightly with repayment of short-dated debt. Discussions are advanced on the next significant maturity, being the 38 million Harrow facility due to mature in April of 16. As mentioned earlier, finance costs have fallen, in part due to the reduction in the weighted average cost of debt, down to 3.9% from 4.2% a year ago. I'll now hand over to Stephen, who will talk you through what further opportunities exist within our debt and capital structure. Thank you.
Thank you, Donald, and good morning. We've made significant progress this year on our capital structure and have an active year ahead. The current low interest rate environment presents an unusual opportunity to refinance debt and deleverage on an earnings neutral, or in some cases, an earnings accretive basis. We think the interest rate environment looks to remain benign for some time, and we will continue to capitalise on a strong banking market and underlying interest rate environments to extend our debt maturities and secure our rates over the medium term. As Donald said, we've successfully reduced our cost of debt to 3.9%, a reduction of 30 basis points. And I think this needs to be considered in light of the fact that our weighted average debt maturity of 8.4 years is well ahead of most of our peers. A further 120 million of near-term facilities are currently under negotiation, and at current market rates, we expect to refinance these at or around slightly lower levels than the facilities are currently costing us. We expect to have refinanced or extended the majority of our 2016 and 2017 maturities over the next 6 months. Our new 303 million facility, secured as part of the AUK transaction, provides us with a flexible facility from a club of 4 relationship banks in the UK that we know well. The facility includes a 148 million revolving credit facility, and this will provide us greater flexibility going forward in managing our cash balances. An attractive prepayment structure has also been secured, which allows us to refinance this debt into the debt capital markets should that opportunity arise. The growth in our portfolio, together with the terms that we are agreeing on new financing facilities, gives us the potential to access the debt capital markets and supports our strategy to diversify our source of funds in the coming years. The next slide shows our lease expiry profile on a pro forma basis, including 100% of the AUK portfolio. The expiry profile shows a relatively even spread of maturities, with just over 30% of our rent roll subject to tenant breaks or expiries over the next 5 years. I think this, coupled with our diverse tenant base and our different sector exposure, provides a very resilient cash flow. If you notice, the relatively high proportion of UK commercial income subject to break options in 2018 reflects exposure to our government-led office portfolio, where there are a number of March 2018 breaks, and these are largely job centres and Departments of Works and Pension offices. Of these exposures, 2.9 million of rent roll relates to job centres in Southwark, Watford, Plymouth and Leeds, all assets with significant redevelopment potential and expectations of lease renewal. Turning to disposal of non-core assets, as Mike said, our remaining shareholding in Cromwell has been sold. This generated £57 million just at the financial year end, and the sale, together with the sale of our Swiss portfolio, has significantly enhanced our geographic and operational focus, as well as reducing our exposure to foreign exchange rates. Cromwell has been a very successful investment and delivered a pre-tax IRR of 16.4% over the holding period and 17.5% in local currency terms. The IRR was driven by a high and growing dividend yield of approximately 7%, coupled with a capital gain over the holding period of just under £25 million. I'll now turn to the AUK transaction and talk a little bit around our funding options of the second tranche, as well as what the acquisition will do to our portfolio on a pro forma basis. Tranche 1 of the acquisition, totalling approximately £267 million, was completed in October and was funded through existing equity and a drawdown of £155 million of new bank debt. The initial hedging has been taken out on the initial drawdown for a period of 3 years at 0.66%, which will be added to the margin, which is currently 2.1% and expected to revert to 1.9% following the completion of Tranche 2. Tranche 2 will complete on the 1st of March for a total cost of approximately £244 million, and debt of up to £115 million may be drawn from the new bank facility. The company has structured this transaction to provide security of funding, limited cash drag, and significant flexibility in terms of our funding options. As we have set out previously, any new equity will be subject to market conditions. We have, however, already secured up to 70 million of underwriting from our parent company, Redefine Properties. In the absence of a capital raise, there is the option, which is entirely at our election, to form a joint venture with Redefine Properties, and this provides security of funding for Tranche 2. Leverage is anticipated to increase into the low 50s following completion of Tranche 2. We are, however, committed to returning our leverage to below 50% and indeed towards the lower end of our 40 to 50% range as the cycle matures. A number of sales are also being actively considered, and these may also serve to reduce leverage and recycle that capital into Tranche 2. Taking a look at the pro forma portfolio position, I'll just highlight a couple of key points. The first is a significant increase in the relative percentage of the portfolio now, or that will be in the UK, up to 81% from 63% last year. A reduction in our relative exposure to hotels from 20% to 15%, and a material allocation for the first time to distribution assets in the UK of approximately £98 million, or 7% of the pro forma portfolio. And these are very high-quality distribution assets, which Adrian will talk to in more detail, and currently experiencing very strong occupational and investment demand. The offices in the AUK portfolio also provide a significant opportunity to drive income from vacant space. As you can see, there's a 20% vacancy there right now, which is contributing to the low net initial yield, and we would hope to grow that significantly with new lettings in due course. Overall, the WALT remains very healthy, in excess of 8 years, and overall, we think the portfolio will be significantly enhanced both in terms of scale and quality. And on that note, I'll hand over to Adrian to talk you through the assets in more detail.
Good morning. Stephen, thank you very much. So the last 6 months for us have been an extremely busy period, both within the existing portfolio and then, of course, more particularly on the purchase of the AUK portfolio for 500 million, which takes us to approximately a 1.5 billion gross asset value. We're going to take a look at what this means for the company, the reasons behind why we like the AUK portfolio, take a look at a few of the properties, and then also finally an update on progress in the rest of the portfolio. So the key metrics post the acquisition of the AUK portfolio. Top left to bottom right, we're now 1.5 billion of gross asset value, and 28% of the total portfolio is now in the London area. 45% of the total portfolio is now in London, the big 6 UK cities, and the big 5 German cities. And 64% of the total portfolio is in London, the big 6, the big 5, and the southern part of the UK. Now, the reason that we're highlighting these statistics is that it is our view that investment, certainly for the medium and longer term, is about getting equity in the right place, where there's the greatest economic activity. Rent's the residual of economic activity, and get the equity in the right place, you give yourself the greatest chance of income continuity and the greatest chance of 1.1 phone calls for a square foot of space. In other words, the greatest chance of rental appreciation. The combined portfolio has a WALT of 8.3 years, and 37% of the total portfolio is index rents, and that's, of course, principally the German exposure. So why did we like the deal? We're buyers of the property fundamental. That's our mantra. We like buildings that are of a size and a configuration in an economic and a demographic that means they're capable of maintaining a long income stream. This doesn't mean to say that we're going to sign a 25-year lease on every expiry, because those days, I'm afraid, are long gone. But it means that when the lease expires, we've got the least possible void and the greatest chance of income being re-signed. Our feeling is that the next play in the property market is likely to be an income play as the UK economy gradually improves, and the portfolio being prime both in terms of location and quality of bricks and mortar puts us in excellent position to take advantage of the approving economy. The capital element of any investment can be volatile, and something happens over there which affects you over here, and guessing what's going to happen over there that may affect you over there is very hard on occasions to judge. Our aim is to get the income element of the decision-making process right as best we can, and we then will asset manage the asset and pick our moment for disposal to try and optimize the capital element of the deal. So the Aegon deal, an institutional quality portfolio, good bricks and mortar in good locations. 75% of the portfolio is in London, the South East, and the big 6 cities throughout the UK. So the economic drivers within the UK largely. It's institutional quality, which is really this income point that I've referred to. And then there's a volatility point as well. The lesser the quality of bricks and mortar and location, the greater reliance you have to place upon the length of lease and the covenant to provide the valuation of the property. The better the quality of the bricks and mortar and the location, the less absolute reliance on the bond type quality of the property. And we think that in a low interest rate environment that we're in, possibly with the next move highly, well, not possibly, highly likely to be in an upwards direction, there is a lower correlation between interest rates and better quality property than the converse. So we think we're well placed in that regard. Acquisition of the property allows us to look at the rest of the portfolio and recycle some of the slightly poorer stock that we've got out of our portfolio, and we'll be looking at that very closely in due course. The initial yield is 5.4%. There are a number of leases within the portfolio that are contracted that are in rent-free, and once those rent-frees are washed through, the initial yield rises to 6%, excluding the London offices, which are partly refurbishment and redevelopment stock. Looking at the 3 main sectors, retail, principally retail parks. 80% of the retail parks are in London, the South East and the Big 6. Prior to acquisition of any asset, but more particularly retail assets, we carry out a detailed tenant audit. We phone all the tenants up. We ask them how they're trading, whether they want more or less space, and those sort of questions. We did that for every single one of the retail tenants. Nobody reported poor trading and that they wanted to leave. And everybody reported satisfactory trading at the prevailing level of rent, or indeed some of them are in the upper 2 quartiles. And I think as I'll point out going forward, we've got some expiries right in our face. And since acquisition, every single one of those tenants with an expiry has put a formal legal notice in for renewal at or above the ERV at the point of acquisition. We've also got a number of upsize requirements within the retail portfolio. We've got no retail space vacant at all in the out-of-town retail portfolio. So we're going to have to work hard to try and free some space up for the likes of Next, who want some more space within the portfolio. 6.5% excluding London's the initial yield, and 6.3% including the London stock. Offices, 97% of the office portfolio within the AUK portfolio is in London, the South East or the Big 6. Again, a similar theme, get the equity in the right places. Within the London portfolio, it's really about refurbishment and extension possibilities, which I'll come on to in a minute. The portfolio of offices outside of London is Leeds, Manchester, Edinburgh, Reigate and Warrington, the small building in Warrington. All of the offices have 1 floor vacant, apart from the Warrington one, which is let on a long lease. And once we've let the vacant space, the yield on the offices portfolio increases to 7.3%. And I'll come on to that, why that's an important yield, particularly for the Big 6 and the South East in a minute. Distribution, logistics, 100% in the South, the South East, or on a motorway junction. As I'll come on to, when we look at 1 or 2 of the examples, we've got tenant demand above ERV, an initial yield of 6.2%. So we're not going to go through every single one of the properties, you'll be happy to hear, but I've just picked a few of the larger, more relevant ones to give you a feel for the quality of the stock that we've bought and the locations that we've bought, so bricks and mortar and location. This is the London element of the offices portfolio. So the first one, Charing Cross Road, and then Grosvenor Street. Charing Cross Road, within an area of intense activity, it's right next door to the Crossrail site, right next door to Alma Cantor's refurbishment and redevelopment of the Centre Point building for offices and residential. What's the important point? We've bought a building with 2 shops and 3 floors of offices. refurbished 5 years ago, air-conditioned space, let at an average of £40 a square foot in the offices, and deals are being done now at £75 a foot in this vicinity. Next door, we've got Derwent London's development. They're going a lot higher than our building. And so going forward, there's an opportunity to try go higher. And we'll also be looking at sites around us. And where it's economic, we'll be trying to acquire and go out and up. But with an area of rapidly increasing rents, it's a great starting place for an investment, exactly the sort of thing that we want to hitch our wagon onto. Grosvenor Street, absolutely prime Mayfair, acquired at just under £2,000 a square foot. Owner-occupied activity in the locality at £2,000 to £2,500 a square foot, 31 to 39 million. Prime rents in this locality for refurbished space, which this isn't as yet, £100 a foot with yields of 4% or sub 4%. So we get possession in March. We'll be aiming to go in, refurbish, and we'll either sell it to an owner-occupier if somebody offers enough, or we'll let the building and own it within the portfolio, or sell it, depending on market conditions at the time. But it's a lovely investment to own. It's got international investor demand, highly liquid stock. The price will obviously move in any market, but you can always sell stock like this if you had to or wanted to. The regional offices, two of the big six examples, Leeds and Manchester, both absolutely prime within their location and really top quality buildings. Similar characteristics, Leeds let at about £25 a foot. One empty floor, evidence in the locality at £26.50 to £27 a foot. We let the empty floor and we get some runoff in rent freeze within some of the let space. The yield goes to 7% and evidence in the locality at 6 to 6.5%. So once we've got it let, income stabilised, there should be a nice NAV appreciation on the investment. Deansgate, Manchester, absolutely prime within Manchester and a great quality building. Manchester's the number one office market outside London and the southeast. Again, let at about £24 a foot. Evidence at the time of first putting the slide together at £30 to £32 a foot in this location, and a deal has just been concluded on 7,917 square feet of space. It's a number that's imprinted in my brain for a particular reason, at £34 a foot. We've got a floor of 15,000 square feet, sorry, and we could do an 8 and a 7 or a 9 and a 6, and we're going to try and get ourselves in that direction if we can. Our ERV is significantly less than this. We're more akin to £27 a square foot. But if we hit that, we'll sit on a reversion yield of 8%. And there is evidence in this locality at 4 3/4 to 5 1/4% on absolutely brand new space, which we aren't. But you can see clearly that once we get the income stabilised, there should be a nice NAV appreciation on this building. Logistics, distribution, interesting sector at the moment. It's just been reported that the third quarter, the amount of space let in this sector is 1 million square feet ahead of the long-term trend. So we think we're on the right side of the dynamic between supply and demand in this sector. First one, Camino Park Crawley, absolutely prime institutional stock. This right by Gatwick Airport, 5 units. A great example of demand in the market. We've got 1 unit coming up, let to Northern Foods. They're leaving at the end of the year. We haven't got possession of the unit. We've got interest from 2 parties, one at, one in excess of our target ERV. Average rent £7.60 a foot, and on the airport perimeter, the rents are £10 to £12 a foot. We've paid fractionally over 6%, and according to the Jones Lang index of deals actually done, most recently, stock of this type in the southeast is commanding yields closer to 5%, so we're comfortable in our position there. Express Park in Bridgewater, similar high-quality bricks and mortar. Junction 23 of the M5, average rent £5.45 a square foot. The Bristol market's commanding £6.50 a foot. None of this stuff is being built at the moment, so we're expecting migration of rents. We've got 3 great tenants, XL, who service an NHS contract, Tool Station, and Refresco Gerber. There's perhaps an interesting opportunity on the large unit you can see just alongside our holding. One of these tenants occupies and owns this freehold, so we may have a conversation with them in due course. 6.3 initial, and according to the Jones Lang index of the most recent deals, stock of this type is commanding yields in the region of 5.5%. So interesting opportunity going forward. The retail parks, the 2 largest, Banbury, Oxfordshire, affluent town. We're stuck right alongside a Tesco Extra with Waitrose battling to get a unit on the other side of our park. So the great thing here, we've got multi-visits per week to this locality. Our park let at £24 a foot. There's a scheme just being done called Gateway, which is an open A1, a fashion park, which is commanding rents of £40 a foot. We're roughly 35% or so open A1 permission, and the balance is bulky goods. Carried out a detailed tenant audit. Everybody's happy there. There are no empty units, but we had 4 expired leases, so it's a nervous moment if you're a property director with that. Every single one of those tenants has served a formal notice wanting to renew, and those rents are either at or in excess of our target rent. We'll aim to try and move these rents to £25 to £30 a foot. We've got interest from the likes of TK Maxx, DW Sports and Wilkinson's. Initial yield just under 7% on acquisition. Similar, Priory Retail Park Merton, very similar characteristics. We're next door to a large Sainsbury's and a Marks and Spencer, and over the top of the units, those roofs you can see at the rear, are something called the Tandem Park, which is another fashion park with the rents of £40 a foot. We're let at £25 to £30 a foot. The interesting thing here, we just post-acquisition have secured a review on an outstanding rent review on the leisure unit, which is the front right-hand unit on the photograph. We had targeted nil increase from, it's not an enormous gain, but 136,000. We've agreed 144,000. At the same time, we've secured offers from Benson Beds and Villeray and Bosch at £35 and £37.50 a square foot. The outstanding rent review has been agreed at £25 per square foot. So a great opportunity going forward. We've got other interest from supermarket operators and fashion operators. At the moment, we haven't got the planning permission to allow us to do that, but there is a move to include this property within the town centre status, and that would allow us to open up the range of occupiers that we can get on the park, and the fashion units to the rear are getting £40 a foot, so you can see our direction of travel on this one. I hope that gives you a feel for the type of assets that we've acquired and the quality of the assets. They really are great institutional quality assets where we think we're going to be able to maintain long income streams and grow income, and there's great asset management opportunities within the stock. We're going to have a little look at what we've been up to in the rest of the portfolio, leasing markets and occupational markets. We'll do the leasing markets first because there's some metrics there and it's easier to get a grip on what we've been up to. 157 leases completed during the year, so the guys have been very, very busy, 3 a week. New lettings or renewals totaling 3.2 million, 3.1% above ERV. Rent reviews totaling 16.2 million, which is 5.8% above passing rent, and it's not on here, but it's 3% above ERV. And occupancy, we're not quite at 100%, but 98%, so we're up from 97.6. It's happened, I'm afraid to say, largely because obviously we've worked hard, but it's we have to say the economy has really been the driver behind us within our portfolio. And I think it's worth mentioning the bête noire of the property market, which has been the shopping centre sector, where it's been particularly hard. And I think the great thing here is that not just have we pretty much got our shopping centres 100% let again, is that the type of occupier that we've been letting to has not been temporary occupiers, but we're back dealing with all the proper full line national retailing tenants and international retailing tenants. And I put on there the last one, which is the Grand Arcade at Wigan, where the last 5 deals have been done to New Look twice, Clark's, Holland & Barrett and Swarovski, and they are all great national retailers. And most interesting, we did the first deal to New Look about 12 months ago. The proof of the pudding's in the eating with these things, and they've been trading extremely well. They've chosen Wigan for a new venture, which is their New Look Men. This and one other location actually was the first opening of New Look Men in the UK, and the rent that we have set is ahead of the rent that we were at before the crash. So one swallow, I'm afraid, doesn't make a summer, but it's an encouraging start. This is a repeat of the slide that I said we'd show from previous sessions. I'm not going to, you've seen this one before, but just a very quick update. So City Arcade in Ingolstadt, this is the extension of the Henderson Ritz. We've cleared the Mall, we've signed Primark, and we're on site building away there, so great things to come there. Western Favel, phase 1 and 2 on site. This is the reconfiguration and improvement of the ground floor Mall. Great things going on there. The second phase, well, this is the third phase, will be an improved anchor to the weaker end of the upper Mall, and we're working away on that at the moment. Crescent Centre in Bristol, for those who can't remember, this is the worst house in the best road in Bristol. right alongside the train station. Rents here are £28 to £30 a foot. We're £11.50 a foot. We're improving the reception, bike storage, cafes, all that sort of good stuff. We hope to get planning in the next 3 weeks, then we'll be on site early next year. The great news is that a secondary building, not in this best road in town, has actually achieved between £13 and £15 a foot. We've got a target of between £13 and £15 a foot, so it's looking pretty positive for us. And the keenest deal now done in Bristol is just sub 5%, obviously on a better building than ours, but it's you can see there's great investment activity in one of these big 6 locations. Birchwood, St George's, take it as read there. I'm going to mention the last one. It's not a huge investment, but it does show that the guys have worked really hard. This is a 30,000 square foot office building in Swindon, vacant. They've chased the tenant. They've secured the tenant. Well, we're inches away from it in truth. And we're about to sign the long lease to Oxford Brookes. And that is a really fantastic achievement by the asset management team. I hope that gives you a feel for what we've been up to and the reasons as to why we've acquired the AUK portfolio and why we think it's great for us going forward. Thank you very much.
Thank you, Adrian. Just to wrap things up and have a look at the future. I think as you can see, we've taken the decision to forego immediate growth in earnings per share to secure our long-term future. And we don't apologize for this. It's we think it's the right thing to do. So we've sat with the cash. We've acquired a very good portfolio. And if Adrian thinks he was nervous about 4 leases expiring, not as nervous he's going to be with 500 million of kit to deliver to all these people. So good luck there, but we think we've done the right thing by foregoing immediate short-term growth. We believe that the markets are currently the current markets will continue to be favorable for real estate companies that have got the right kit. And we now believe we have got the right kit in the right places. And the over-rented, out-of-town, long-leased properties that I think are going to fall in value, we have substantially moved towards a institutional quality type of portfolio, but still have the business model of an income play. So that's where we are. The occupational markets we see being supportive of income growth, which is good if you've got the right kit. We therefore are very confident of continuing to deliver sustainable, low risk and growing earnings going forward. And that's in the long term, not just the short or the medium term, but long term. We're very confident that our earnings stream is sustainable. We will make use of the strong investment markets, as Adrian said, to sell. If we bought at 7, we should be doing the right thing and selling at 5. So everything is for sale, as long as we can make a good turn on it. This will partly help to reduce the temporary increase in the leverage post the AUK acquisition, and we still haven't quite finalised what we're going to do in terms of a debt-equity mix to fund phase 2. Our target loan-to-value, however, remains at the 40 to 50% loan-to-value level, and we'll continue to stick to that. We believe the interest rate environment is expected to remain lower for longer, and we intend to take advantage, as Stephen said, by re-gearing and extending our debt facilities wherever and whenever possible. We also intend to access a wider source of funding, both debt and equity, which we hope will reduce our overall cost of capital, because it's still quite expensive, and we need to work hard on reducing the overall cost of capital, and that's the debt and equity mix. Returns in the year ahead are expected to be driven by income growth, together with a lower cost of debt with an enhanced geographic and operational focus. So we're now very focused. We're going to work the portfolio extremely hard, and that's where the growth will come from in the next financial year. In conclusion, we reiterate our target dividend growth, which we've been able to meet over the last number of years, of CPI plus 1 to 2% per annum. On that note, I will hand over to the operator for questions. Do we do floor questions or operator questions first? Floor questions first.
Thank you for the presentation. My name is Erik Saltz, JP Morgan. Can you comment going ahead on how the portfolio would ideally look like in terms of locations and segments?
I'll take that question. I think we've always been opportunistic. I think our focus for the moment is very much on the UK and Germany. So those are our two geographical focuses. I think as we've said in previous presentations, the opportunities at the moment are probably better growth potential in the UK in general, but in the German markets is obviously an opportunity for very high initial yields, slightly higher ungeared yields on assets, and exceptionally low cost of funding on debt. So I think we'll remain opportunistic to the extent we can find assets in Germany that can deliver the property fundamental that Adrian talked about. Then that's attractive with a low cost of funding. But I don't think we haven't pinned our flag to a specific allocation. It'll be more opportunistic.
But I think we will stay in the three sectors that we have, so commercial, retail, and hotels.
Any idea of adding another country or region? Or?
At this stage, no. We've focused on Germany, UK, and we think that's where we'll stay for the foreseeable future. However, radiating out from Germany are some interesting opportunities, but that's for another day.
If you could just remind me, on the UK side, with these favourable positive valuation movements, is it yield shift we're looking at here, basically, in these increases?
Limited yield shift, limited.
Was it mainly that?
Growth, yeah.
It was mainly that?
And voids.
But now that's, by the tone of this conversation, is changing somewhat. We may see the rental side of this contributing more.
It should do.
Yeah.
It should do. We think yield shift is largely done because interest rate environment has probably reached an all-time low and going to stay there for some time, but yields can't come down much more, you would think. But rental growth, and because our shopping centres and our buildings are now full, as Adrian says, when you get more calls than space you've got, rents have to increase.
You bought a hotel during this period in Scotland. I've stayed there. It's very nice. So have you seeing any...
I hope you paid the rack rate.
I always seem to. And have you any others under contemplation now that the percentage has fallen a bit?
Well, we're down to 15%, but you would have noticed that we assisted our hotel management company to float a new property-specific hotel company, and the hotel business will probably grow through the growth in that company, in which we have a stake.
And if you could just refresh me on the second tranche of this major deal, that's still the historic valuation,
yes,
isn't it? So we are getting some time advantage.
We are
coming through this, which should show through to
that's
advantage.
Absolutely correct, and it's looking very positive on the asset management side. So we've done a business plan for every property, and we were very conservative in that business plan in the sense that if we didn't know the tenant was going to stay, we assumed 12 months, 18-month void. And a lot of those are now re-signing, so we don't have those voids, and we've got interest in the vacant space in many of those, which we had assumed would take 2 years. I don't know if you want to comment on that, Adrian.
No, I think you put it very well. I mean, so far we've beaten the target business plan and everything we've done.
So, the other thing I was going to ask about was Germany. Do you have any particular plans that will boost what you bought in the last 2 or 3 years?
You mean asset management?
Yeah.
Absolutely. We haven't mentioned it today, but the portfolio that we bought of 165 million euros, about a third of that, they are very, very active in Germany, working up re-gearing, extensions.
I see. Okay. Good. Thanks.
Thank you, Keith.
Morning, it's David Brockton at Liberum. Can I ask, just on the UK portfolio, can you just give us a feel for how long you think it will take to let up the floors in the office portfolio, whether you've got tenants lined up there, I guess is the first one.
Sure. It's a great question. I wish I knew the answer exactly. I mean, I can tell you we've got, we haven't got deals in place on any of it. But we have put terms out on both the Reigate property and the Edinburgh property within the last 10 days. So,
okay, and sort of fill them for incentives for those types of locations?
Yeah, I'm going to be slightly coy. I mean, the rents that we've put terms out are higher than our ERV and the incentives are less.
Okay, thanks. And second question, more broadly just on the EPRA cost ratio, once you've got the AUK portfolio in there, any feel as to where that progresses through the current year, or is there a mix impact that we should be thinking about with the AUK portfolio?
Yeah, I mean, I think the once the AUK portfolio becomes fully embedded, I think there's probably a slight increase in resourcing, but I think that sort of 15 to 16% range is where we'd like to keep it, and I think we can manage it within that band.
Okay, thank you very much.
Hang on.
Sorry.
Hi, Sam Wood from Merrill Lynch. Just curious on the small investment into International Hotels Group. Is that, anything of particular interest we should pay attention to?
It may be. What we always said is hotels were a key asset for us, but we didn't want to become a hotel REIT. So we had a self-imposed limit of 20%. However, the hotel market, investment market has been going crazy, and there have been opportunities to acquire substantial portfolios, which we would not have been able to do within RIPLC. So together with our associate company, Redefine BDL Hotels, we came up with the idea to float a separate specialist hotel investment company, which we see will grow to whatever limit we can get to in terms of the right product and whether we're able to raise capital. So we've taken a small stake in that, and we will add that stake to our investment in the current 8 hotels and ensure that that's limited to 20%. This could grow quite large, and we would not intend to keep our relative percentage, but probably dilute over time. And if we dilute it to a point where it was too small to be of interest, we would then dispose of it. But we see it as a very, very good opportunity to grow net asset value and to make a good turn by using the hotel expertise to acquire these assets, to build them up, and then perhaps to realize value.
Should we go to questions from the phone?
If you would like to ask a question at this time, please press the star key followed by the please press the star or the asterisk key followed by the digit 1 on your telephone. Please ensure that your mute function on your phone is switched off to allow your question to reach our equipment. If you find your question has already been answered, you may remove yourself by pressing star 2. Again, please press star 1 if you would like to ask a question. You can pause now for just a moment to allow everyone's signal. Again, as a further reminder, please press star 1 if you would like to ask a question.
No questions.
We have no questions via the phone at the moment. I'd like to turn the call back over to you for any additional comments.
There are no questions from the webcast.
Thank you very much from the Redefine management team, and see you for the interim results in 2016. Thank you. Bye-bye.